So thank you again for joining. As I said, my name is Sarah Hendy. I'm the Strategic Partnerships Manager here at Blackfinch Investments. And today we're going to have a look at ESG. And I've entitled this presentation, Mind the Gap, because the aim is actually for me to point out some of the areas just for you all to be aware of. So what I've actually done is I've split it into two sections because I thought it'll be more helpful then for you to refer back to areas that you may want to revisit. So in part one, we'll have a look at the background, some of the global initiatives. We'll also have a look at what ESG actually is. And then I'll explain some of the differences. As we all know, we work in a sector that's very heavy on jargon. So I think it's always sometimes it's really helpful to just point out the obvious. I'll then have a look at some of the investment processes and some of the key points, particularly around screening, fund management, and ESG ratings. In part two, well, this is slightly changed. It was going to be a little bit of an update on MiFID II and the SFDRs, which are the Sustainable Finance Disclosure Regulations, but the FCA changed their mind on that. So I'll give you an update on where we are when we get to that part. I'm also going to give you some examples of questions that you can use for asset managers, fund houses, and also within your client fact finds. I'm then just going to revisit a little bit on explaining the jargon and just revisiting what the differences are between ethical and environmental, because that is still one of the key areas that clients in particular do get confused. Before then looking at some of the opportunities that actually ESG can offer. And then we'll just finish up with how we can help support you. So just covering off the learning objectives for today. So by the end of today's session, you will be able to recognise the main issues to be mindful of with ESG investments. Understand the reporting considerations and preferences that need to be taken into account in the investment and advisory process when considering ESG, and be able to articulate to clients, or obviously in your circumstances to your advisors and to help them, the differences between ethical and environmental. So I'm just going to start with a little bit of the history and where ESG came from. So as some of you may know, the term ESG was actually reportedly first used back in 2005 now, and it was in a landmark study following a conference that was entitled Who Cares Wins? And this was hosted by the United Nations Global Compact, the Federal Department of Foreign Affairs for Switzerland, and the International Finance Corporation. So some of the lead organisations for you to be aware of today are obviously the United Nations SDGs, these Sustainable Development Goals, and they are a universal call to action. Now, sitting alongside them, we have the United Nations Global Compact, and their role is to help companies to align with the United Nations SDGs. Now, the one that you probably all will have heard of is the United Nations 2015 Paris Agreement. Now, this is a really important agreement within the UN framework on climate change. And it is actually the one that was very controversial because Donald Trump pulled America out of this. So there is hope now that with Joe Biden just about to be inaugurated, he has already said that he would like to rejoin this. So that's really good news. Now, the next one is the PRI. Now, these are the principles for responsible investment. And the PRI is the world's leading advocate of responsible investment, and it works to support its international network of investor signatories. And their aim is to advance the integration of ESG factors into signatory companies, so within their investment and ownership decisions. Now, I believe at the last count, there was something like over 7,000 corporate signatories to the PRI in 135 different countries. And I'm actually really proud to be able to tell you that Blackfinch is one of those corporate signatories. We actually signed up to the PRI last June. So personally, I think that people's increased usage of social media has really allowed a platform for ESG and responsible investing to be heard by the masses. And I think this can really be seen in some of these figures here. So as you can see, we've got over 3,000 different ESG funds available in the UK today. inflows of over 71 billion globally between April and June last year. And industry research shows that the top 20% of ESG companies have consistently outperformed the market. And that's actually really important, because when a lot of the funds were first launched, there was a fear that they were more about people doing the right thing than actually them returning and being proper investments in their own right. But obviously there's more funds available now, and it's just demonstrating how ESG can really work. So what does actually ESG mean? So it's actually a way for companies, their staff, their shareholders, and potential investors to gauge how a company responds to climate change, maybe treats their workforce, manages their own supply chains and cultivates innovation, and also, very importantly, builds trust in their brand. Now, although there's no definitive list of ESG issues, as they are constantly changing, broadly speaking, they cover things like, well, we can all guess on the environmental side. So it's things like air and water pollution, climate change, biodiversity loss, deforestation. The social one was the one that actually I learned the most about. Just to let you know, over the course of last summer, I actually undertook a foundation course in ESG, which was run by the PRI. And it was actually very interesting, and I can highly recommend it if any of you are considering doing qualification. So the social one, the societal issues include things like labour standards, impact on local communities, product safety and liability, product mis-selling, and things like access to affordable products and services. Now, the governance, again, this is one that's pretty easy to actually guess at, the majority of them. So it's things like how companies do their accounting, have an audit committee structure, things like board composition, diversity, equality, executive remuneration. So I want to get on to one of my first mind the gaps and explain a couple of the most common confusing areas, starting with what and where does sustainability fit into ESG? Now, according to the World Commission on Environment and Development, the definition of sustainability is that sustainability meets the needs of the present without compromising the ability of future generations to meet their own needs. So sustainable investing actually includes ESG, but it takes it a step further, and it focuses on companies that lead their sector in ESG. So I guess if you look at the little diagram, the three rings on the right-hand side, I guess you could say it's kind of the crossover between that environmental protection, social progress, and economic growth. Now, another confusing area for everybody is actually the difference between all of the different investing. So you've got ESG investing, socially responsible investing, impact investing, ethical investing. There probably are more than this. So I just thought I'd give us a little bit more context here. So ESG investing, well, this uses metrics by which to measure a company's risks outside of a financial accounting framework. Whereas for SRI, it's investors using screening and exclusion, divestment, positive reinvestment, and shareholder activism to achieve positive social and environmental outcomes. And we will come on to screening in a moment. Now, impact investing is placing your money in a specific way. So investing in companies and funds with an eye toward both financial returns and measurable positive social and or those with an environmental impact. And the final one I have here is ethical investing. So this is an example of where screening is commonly used. So for example, it allows investors to screen out the so-called sin stocks. Now these are things such as alcohol, gambling, tobacco, armaments, and it's also sometimes known as values-based investing. Now, ethical investing is the one that constantly does get confused with environmental, so I will pick up on that again a little bit later. So I now want to look at some of the actual investment processes, as again, it's really important that you understand these so that if you're required, you can help to explain them to clients, because it's really important that from an advisor's point of view, that you can agree the approach that is best suited to the client. So the first point to understand is the use of screening. Now, typically there are two different screening approaches, positive and negative. So positive screening is the process to identify key trends, themes and processes. And the most important factor for advisors and their clients to understand is that it will include companies that are on a path to improve their ESG rating. This is actually the approach that we take at Blackfinch. Now, the difference is negative screening, as I just mentioned, will exclude part of the market. So it is crucial for those clients that want to exclude certain activities, these so-called sin stocks that I mentioned. And it is the approach that most ethical investors would look to use. Now, one of the mind gaps to be aware of here is that actually different fund houses can use different approaches to positive and negative screening. So it's really important just to be aware of that and to find out exactly what the criteria behind the positive or negative screening is in order for you to fully understand how each ESG fund is being screened. There's actually one shoe doesn't fit all here. So it's really important just to always be aware that different fund houses may use different approaches and just understand what they are. So not as important for clients to understand this one, but for those who read the financial press, they may be aware of this, is active and passive management. So I'm just going to cover off that as well. Now, currently active management is considered by many to be more encompassing and better suited to ESG investing, because the key points are that it can engage with companies on ESG issues. It can also play a key role in exercising proxy voting. And it also allows the managers to pick individual stocks based on both quantitative and qualitative ESG data. Passive management, although it's generally cheaper, it typically only uses quantitative ESG data. So it limits investor opportunities to engage and maybe help companies who are starting their ESG journey or looking to improve from an ESG scoring perspective. Okay, so the next point I just wanted to pick up on is whether who cares wins is actually true. Now, I did allude to this at the start. So what I mean by that is there now enough evidence to support the fact that ESG is more than investors just doing the right thing? So can they go into the mainstream for more people? And actually, do the investments stack up? Well, there is a lot of opinion on this and a lot of data, but the popularity of responsible investing is growing, so it's just worth quoting a couple of the well-known names. So as you can see here, the first box on the left-hand side, I've got a quote from Morningstar, and they said, and now this was from the start of last year, that they had undertaken a study and they didn't find any they found no risk-reward trade-off to investing in ESG on a global level, and only a slight cost if they limited the universe to just funds based in the US. BMO Asset Management said that their research consensus pointed to a positive ESG performance link at a company level with reduced risk and volatility as a key driver. So that's a really good and positive statement. And then the FT, an article I found from last June, they did actually state that close to 6 out of 10 sustainable funds delivered higher returns than equivalent conventional funds over the past decade. So it does seem to be now that is now growing evidence to support that these investments do actually stack up in their own right. So The final mind the gap that I wanted to highlight before we move on to the second part of this session is actually ESG ratings and due diligence. Now, this is something that you might get involved in yourself, because I appreciate that as paraplanners, you undertake a lot of the due diligence for your advisors. So this one is really something for you to be aware of. Now, this slide actually shows some of the bigger ratings companies, but the problem is they all seem to have different approaches and different scoring systems. And as you can see from this chart, the problem with this is that it actually can create a divergence in ratings across companies. So as you can see, some companies will have, so on the environmental side, they'll have some Facebook, and the top one on the left-hand side. As you can see, the FTSE has it right down at 0, and then on another chart, JP Morgan is right over in the 75 to 100 bracket. So it's really important just to bear this in mind. And actually the best advice that we can give is to actually seek clarification as to what basis is being applied to generate the scoring, and to use more than one ratings company so that you can actually come up to your own conclusions or an average. Okay, so before I move on, I did also just want to highlight the fact that ESG is not just about mainstream investing. So for those of you who obviously work in the tax efficient side, it can absolutely apply here as well. Now, as I mentioned earlier, some of you will be aware of who Blackfinch are. As I said, we primarily work with Succession advisors on our tax efficient products, and we do have a range of them. So I just wanted to highlight how ESG can work on non-funds. So for example, within our inheritance tax portfolios, we invest into three different underlying trading activities there. The main one is obviously renewable energy. So obviously that gets a big tick in the box from the ESG point of view. And we also invest into property and development and asset-backed lending. So going forward, our loans will be with property developers who are maybe looking to develop low carbon developments, or they're regenerating inner cities, or they may be looking to offset their carbon footprint by doing some greening within city centres. Now, on the EIS and VCT side, it also can work here. Our offerings within the technology space at the moment, they're generalists, but they're predominantly within technology. And obviously, as we mentioned earlier, one of the hardest or the least recognisable parts of ESG is actually the S, the social and societal investments. So societal investments in technology that can make a difference. So that is what we are aiming at. We're also looking to invest with smaller companies who may have innovative products. Innovation is one of those S's within the societal issues. Investing to enable growth and job creation. Again, these are huge social matters. We also put non-executive directors onto the board of every company that we invest with, and that's to actually assist with the G, with the governance. So it's just really to show you how ESG can work from a tax advantage point as well. So in this second part of the presentation, this may not be quite of importance to you as paraplanners, but I do still think it's worth you having a really broad understanding of everything that I would normally present to if I was presenting to advisors, because then if you want to be able to cascade this and, as I say, share this with any advisors that you look after, then hopefully you will have the ability to do that. So the one thing that I did want to just give you a quick update on was, well, it was going to be the Sustainable Finance Disclosure Regulations. Now, some of you may be aware of these. There was a lot of talk about them because they were going to be implemented by the Financial Conduct Authority this coming March. Now, a lot of firms will have already started to actually implement these regulations, And so it did cause huge consternation. And I think it was either at the end of December or the end of November or the start of December last year when the FCA suddenly announced that they wouldn't be implementing the SFDRs because they didn't believe that and rightly so, they didn't believe that the UK Parliament would be able to legislate the SFDRs before the December 31st deadline. So they announced that they wouldn't be implementing them. Very helpfully, at the time when they were asked to expand more, they just replied with a no comment. But luckily since then, at the start of December, they have now issued a policy statement on climate-related disclosures. I have to admit, I haven't read through the document yet. I have got it downloaded to do so, but I believe that there will be more news coming from the FCA on what they're going to do in the UK this year. So it's something just to be aware of. But as I said, we do know that the government has committed to greening Britain. There's been a lot about that in the press at the moment. So it very well may be, if your advisors have clients, or if Succession as a company is starting to get your internal processes in place, that you do start to think about some of the compliance and due diligence that may be required for any legislation that the FCA do implement. As I said, we do believe that there will be changes coming and that the FCA will implement some regulations for the UK over ESG factors. So if that is the case, obviously we don't know when that will be, but it would be worth just starting to think about what research that you will need to take on asset managers or fund houses that you work with. So what I've done here is just to put a list of questions together so that maybe you can take some of these and develop your own crib sheets of potential questions that you could ask. So things like, what are your ESG policies? And the important thing here is to follow it up. Can I have a copy? What is your screening approach, and what ESG data or research do you use? And again, get a copy of this. As I mentioned when we were covering off that point, most companies will have slightly different approaches. So you will need to get the supporting document to be able to actually understand which approach that they are using. And as I'm sure you've all heard of, the terminology of greenwashing, it is really important that you not only build up a picture of what each company is doing, but that you do insist on receiving copies of their policies and documentation just to support what they are telling you. Now, obviously, it's imperative that you follow a similar process when it comes to clients and fact finding. So again, it might be worth considering putting together a crib sheet or a set of questions that you can ask. And actually, personally, I think this is more important than the research that you will be undertaking on the fund houses, because it's so easy to get things wrong. So I wanted to highlight and mind the gap here, because it's going to be really important how you structure the questions that you ask clients, and that you actually expand and seek clarification about a client's preferences. So what do I mean by that? Well, don't just have a fact sheet that says, this is the question, tick box, yes or no. And to put that into context, what I mean is, if you were just to say testing on animals, Mr. Jones, Mrs. Jones, would you be happy to have an investment within your portfolio that tests on animals? The chances are everyone is going to say no. But if you then expand on that question, is that just testing beauty products on animals? Or what about companies that only test to improve fertility chances in humans? Or what about companies that only test on animals for cancer cures? Or what if that's only cancer cures for children? Now, obviously, you're going to get a lot of different responses depending on how you pose that question. So an alternative suggestion could be to start questions that could include things like, do you want to exclude companies that have different values than yours? Do you want to integrate companies that reflect your values, or select investments that make an impact you can see? And that's really important when you're then going back to that using the negative or positive screening, because depending on whether people are happy to have companies that are looking to improve will make a big difference which then investments you consider or your advisors consider for them. So, as I mentioned earlier, jargon is massive in our sector, and it is something that the FCA are really keen that we try to simplify, particularly when you're speaking with vulnerable clients. So another idea could be to produce a client-friendly crib sheet on ESG. Now, as I said, I spoke earlier about ethical and environmental, and this is still one of the most common confusions for clients. So I did just want to re-clarify exactly what the difference is. So ethical investing is the practice of selecting investments based on ethical or moral principles. So it avoids those so-called sin stocks. Now, this is very important for people who may have religious beliefs or may previously had addiction issues, and they may just not want to invest in anything to do with alcohol or gambling. Whereas environmental investing considers how a company performs as a steward of nature. So it's how a company disposes of hazardous waste, maybe uses re-greening projects to offset its carbon footprint, or considers biodiversity risks that are associated with the products that they are producing. So again, it's really important just to have a firm understanding of the differences between ethical investing and environmental investing. Now, you'll be delighted to know that I am coming towards the last part of this presentation. So I'm just going to explore the opportunities that the rise of responsible investment offers and the part that social media has to play here. Now, obviously, this may not be so relevant to you, but I do think it's still of interest because I know so many of you have so much involvement in the day-to-day activities of your advisors. Some of you yourselves may be looking to train up, maybe currently undertaking qualifications to become financial advisors yourself. So if I was to get you to do a straw poll of probably yourself, your clients, your friends and families, what percentage do you think don't either own or use a smartphone, an iPad, or an Android of some description? Now, it's going to be pretty slim. So the likelihood is that everyone is going to be exposed to and aware of media campaigns. For example, if you watch Formula One, particularly Black Lives Matter, or #MeToo if you're into the films. And when it comes to ESG, there's no difference here. And don't underestimate the effect that things like David Attenborough has. His new series on the planet, I mean, it's quite frightening when he demonstrates what climate change is doing. Also, people like Greta Thunberg, the teenage activist, the interest that she has generated and the awareness in the younger generation is massive, and it cannot be ignored anymore. We know firsthand from advisors who have told us stories of clients being put under pressure by their own grandchildren to make sure that they do include some kind of ESG into their investments. So it's very, very powerful. I'm just going to give you an example of that, of how social media can impact two companies and their share price. Now, some of you may remember back in 2010, BP had the worst oil spillage in history. It was absolutely horrendous. They received something like 390,000 claims from local businesses, and within 5 days, their stocks fell by 55%. And 7 years later on, they still only recorded an average of $36 a share, whereas it had been up to $60 per share prior to the spill. More recently and closer to home, you probably all remember the stories around Boohoo, which is the clothing manufacturer which was caught up in a scandal involving poor working conditions in a Leicester clothing factory. At the time, they reacted very, very quickly, but it still had a huge impact on their share price, and it did fall. Although more recently, because they acted so quickly and actually distanced themselves, it has actually come back. So it's just to show you how social media can today play a huge part in the performance of companies and how they need to be really mindful of social media and the impact of ESG. So some of you may have come across this. It is actually a statement that I use an awful lot. And I think it's not all bad news on social media front, and you can embrace it and use it to your advantage. Now, as paraplanners, you will work a lot with your clients and your advisors. And actually, one of the most important things, a subject that's huge within our sector at the moment, is the subject of intergenerational wealth transfers. And it's something that if it's embraced, and this is something you can really help with, it will enable you to help develop your advisor's business, because they need to start to engage with the most important people after their clients, their beneficiaries. And why do we say that? Well, research by US publication Investment News suggests that around 2/3 of children fire their parents' financial advisor after they receive their inheritance, but just 13% of the advisors who were surveyed ranked generational wealth transfer as a business risk. Now that to me is bonkers, because that is huge, and it just shows you the importance of getting to know the beneficiaries of your clients. Now, just putting that into context, in the UK, there was some research undertaken, it was a couple of years ago now, by the King's Court Trust, and it was entitled Wealth Transfer in the UK. And actually that backed up that statement that came out of the US there. And they stated that where companies had no intergenerational planning in place, that 15% of the practices that they surveyed reported losing 50% or more of the value of their assets under management. And the main reason that they cited for this was lack of relationship with the beneficiaries. Now, that same research also stated that younger clients, so those same beneficiaries that your advisors need to get to know, stated that they preferred to work with younger advisors, but an incredible 75% of the practices that they surveyed had no policy in place to hire a younger advisor. Now, to me, this is where you can really add value to the relationship that you have with your advisors, because this could be something that you could take on board. You could be the person to actually try to establish that initial relationship with your existing clients, beneficiaries. So to me, this is a huge opportunity for you to make a real difference to your advisors and to the company. So what else do we know? Well, we know the millennials are the clients of tomorrow. Now, we also know that the baby boomer generation is shrinking. So clients of tomorrow and the future are going to be very different. They're going to have very different needs, probably be transactional and life event driven, with protection needs associated with young adulthood, starting a family or buying a home. And the next generation of wealth accumulators could also still be carrying debt, and the previous generation's financial security of employment and a solid pension probably won't be the norm going forward. So the chances are that a good percentage of wealth accumulators will also still be financially supporting children and helping them with things like getting onto the property ladder. Now, I think we can all resonate with that. If you're trying to buy a property today, just to get enough money for a deposit is a massive issue. So the whole dynamics of clients of tomorrow is changing. And this is where embracing social media is really going to help, because the clients of tomorrow are those clients or people who today may be in their 20s and 30s, even their 40s, and they all use social media to actually communicate. So it's a real opportunity for you within the paraplanning team to actually add value, because a lot of you will be far more familiar with using these types of social media than maybe some of your advisors. So this is where you can really hold your hand up and really help and add value. And you may even want to consider getting an app. There are some really good financial apps now starting to come onto the market. So it's well worth considering and looking out for something. So just to finish up really, how can Blackfinch help? Well, we only do a ESG. So if you do have advisors that are looking or considering for clients, or clients who have requirements that want ESG across either their tax efficient side or their mainstream side, then obviously we do have solutions already in place. We are currently working on an advisor ESG pack that will include some of those crib sheets. I believe that that's just being finalised at the moment, so hopefully that will be available within about a month. So I will make sure that I send a copy over to Laura in case that's of interest to you. Obviously, we can support you. We do a lot of presentations, so any subject that may have interest, please do ask. And obviously, if we have a presentation, then I'd be delighted to jump back on another Zoom to deliver that to you. If you would like any specific product training in any of the areas that we cover, obviously we can help. Obviously, we've got business development managers around the country to work with you and also your advisors. And we have a lot of literature. So if there's anything that you need, just give me a call.